So I'm going to present the latest research about Bitcoin. It's not out yet. Well, actually, it's on archive, not in journal yet. It needs to be said that this is partially financed by European Commission under the 7th framework program, so that just needs to be noted. It doesn't necessarily mean, of course, that EU is a fan of Bitcoin, but that's the part of the research on financial bubbles and stuff around that. So, what is Bitcoin? That's the basic question, of course. This is not an IT or Bitcoin conference related, this is computational social science, so I will try not to go into too much of a detail on technical part of Bitcoin. Plus, I'm an economist, so I don't really feel that qualified to tell about specific technical stuff about the currency. But what's important? Bitcoin is a cryptocurrency, and it mainly works by the fact that the users use it for transactions. They can buy goods, and the transactions are verified by miners who are rewarded for doing so by mining these new Bitcoins. And that's the way how the transactions are verified and how the new Bitcoins come into circulation. This is very important for how the Bitcoin works, because this makes the money supply very well specified and known well in advance, which is very different from standard currencies. Very importantly, Bitcoin is not directly connected to any bank, any government, any state, nothing really. Okay? It is decentralized, so it's very different. It's not directly regulated by any of these. Of course, like US is trying to do something about that, but still it's not really regulated. And importantly also, it's not backed by any physical asset. If you look away from the fact that it's being mined, that you need computational power to mine it and stuff like that, but it's not backed by silver, gold, anything. So it's practically backed by trust, or mainly, or faith, we might say. But, well, how is that different from standard currencies? We cannot really tell, because these days, well, we can say very much the same thing about dollar, probably euro as well. So, why is it worth examining? Well, if you look at this, that's the time series from end of 2011 till end of February 2014. So why would you think it's important to study? Well, because it grew from $5 to $1,200 in 2 years, 2.5 years. So that's something that we might be interested in, trying to make profit on that. Of course, you can see that it goes through various phases, like growing practically all the time, and then something happens. Okay, like growing, Mount Gox gets hacked. Growing, or well, nothing really happens. Then Chinese Baidu, which is like Chinese Google / eShop / everything practically, says they're accepting Bitcoin, so it grows to 1,200, and then Baidu says, okay, not anymore. So it drops, then Mount Gox collapses and it goes down. Okay, so there is a lot of stuff going on, but what's important is that, well, you could have made a lot of money on that, so it might be interesting. And why is it worth examining as well, and why is it interesting, is that there is unprecedented data availability. Even though, of course, for you here and during all the presentations, this can sound as a joke, right? Because we have daily data, so it's not terabytes of data, it's one data point for one day. But if you consider that when we take it as a currency, it's a daily data for money supply, for transactions, and this is something really special, because in macroeconomics, you have these usually on quarterly basis. So this is something very, very different. Instead of having 4 data points a year, you have 360, and this is very different. Also, it's quite a unique financial asset. It can be taken as purely speculative, even though I'll try to show that it's not that true. Short selling is almost impossible, which is very important for financial assets. And the market is very shallow. This means that investment banks are not really that interested in Bitcoin. Pension funds are not interested because there is not enough money, not enough liquidity in it, which is important. And for complex system guys, it has a rich network structure, of course, but this is not what I'm going to talk about. So what's the main motivation for my speech? Is to analyze the behavior of Bitcoin prices without any prejudice or expectations. And this is very, very, let's say, weird for an economist. Because I would try to somehow say who is right between economists who say there are no fundamentals. Okay, it's pure speculation, it's not backed by anything, it shouldn't work. and the Bitcoin fans who say, of course, we are using it for transactions, it has everything. So, but as a researcher, as a scientist, I shouldn't take sides, right? So I would like to look at the data and use something which doesn't really assume much. And this would be continuous wavelet analysis, without assuming, trying to find, based on the data, what's really going on. So I will look at various drivers of the prices, from fundamentals to technical to interest or attention. So something similar to what Marve and Chester were presenting on Wednesday. Then I would like to look whether Bitcoin can be taken something as a gold or Swiss franc as a safe haven. And then I would like to look at the effect of China. Because China Bitcoin is really popular in China, even though I'm not really sure how legal it is. But still, approximately 30% of the volume is made in Chinese renminbi. Most of the rest is, of course, in the US dollar. No one really cares about euros or British pounds or anything in the Bitcoin market. These are really, really tiny. So what drivers I'm looking at? I'm interested in the money supply, because from economic theory, money supply should be important. The more money we have, or the higher the supply, the price should decrease, right? Because the higher the supply, the lower the price. Money demand, how much it's used. The more we use the currency, more demanded it is. So this means that the price should go up. In similar way, price level. If the price level is high, it should influence the price as well, from economic theory at least. Then the technical drivers, which might be quite important, and these two are hash rate and difficulty. This is quite technical, but there is a given difficulty for mining the Bitcoins. It practically says how good or how strong your computer has to be to at least have a chance of mining new Bitcoins. Okay, and this is growing crazily because there are hardware components designed specifically for mining Bitcoins. Okay, so it's not really for standard people, let's say like us, having our Macs or standard computers and mining Bitcoins at home. No, it doesn't really work. You would need to have the whole house filled with these things. But still, this might play a role. And then, and again, this goes quite to the presentations from Wednesday. How is the interest in the currency increasing or decreasing the price? How are these connected? Whether when people are looking for Bitcoin, how it works, whether this boosts the prices or not. Then, as I said, I compare the dynamics of the prices with the prices of gold in Swiss franc. That's because, well, both gold and Swiss francs are taking kind of a safe haven, even though in last years it's not so much that true anymore, but still, at least some proxy for that. And then I compare the dynamics with the financial stress index, which measures, as well, it's called financial stress index, so it measures the stress, if we call it like that, on the financial markets. So there might be some connection as well. And then, as I said, China might be important, so I want to compare the prices in US dollars with the dynamics at the Chinese market. How I do it? I use wavelets. I don't really want to go through too many details here, but well, wavelets are practically filters. Okay, so we can see them as Fourier transforms, but in time, in a way, if we really simplify it. What's important about these compared to the Fourier analysis is that for Fourier analysis, you can look at different frequencies or scales, and you can say what's happening there. But with wavelets, you also spread it across time. So you can not only look at the frequencies, which one is dominant or important, but you also look at how it changes in time. So from technical or even economic perspective, you look at the dynamics, and you say, okay, something is happening at time t, but also in long term or short term. So you can distinguish, and you can look at how it changes in time, which is quite important. Importantly also, it can be generalized to more dimensions. So I will be interested mainly in the relationship between prices and something else, one additional time series. So the wavelets can be generalized to dimensions, so we have some kind of a cross spectrum in time, in a way. This can be taken, well, we can transform that into coherence, which is, well, wavelet coherence again, is the analog to standard coherence in the Fourier version, so we can get some kind of a correlation, squared correlation, how it changes in time, how it's different across frequencies. So again, very interesting. Of course, the problem is that wavelets in general are complex, so it's hard to talk about the direction. For this, we usually take the squared coherence, so we are losing the information about the complex part. But for this, we can use the phase difference, which shows us what's happening. It's usually easiest to show it on a picture. So if we have two time series, okay, so at the beginning, nothing really happens. They're not correlated, right? So, and this is the picture of the wavelet coherence. On the x-axis, we have time. On the y-axis, we have scale. And the hotter the color, the higher the coherence, or the correlation, let's say, even though it's not really correlation, but analog is like that. So we can see that here, these series are practically the same, apart from the noise. So we can see at this given scale or frequency, we have red color, so something's happening. Then again, nothing's happening, so blue, apart of course, from some noise, we have just 1,000 observations, so not so long. Then the frequency increases, which means the scale decreases. So we're up on the y-axis, again, red color. Then again, no correlation, so blue. And then again, frequency increases, so we are getting up on the y scale, y-axis. Important part of the picture are the arrows, okay? And these represent the phase difference. If the arrows point to the right, we have positive correlation. If they point to the left, we have negative correlation. If they are pointing down, it means that the first series is leading the second series. If they're pointing up, the other way around. So we can see here that these move together. So we see red color because they're highly correlated, and arrows pointing to the right because there is no leader. Okay, they move together. So they are positively correlated, nothing, no shift. But here, when we shift the right series to the right, which means that the blue one is leading the red one, we can see that the arrows point down. Okay, specifically here, the blue one leads by pi half. So we can get these pictures that tell us what is going on at which scale, whether it's short or long-term relationship, and who is the leader. Of course, these are just like nice examples, right? It usually gets more messy, but still. Now, what I do, what data set do I use? I use Bitcoin price index from CoinDesk. That's, well, I can use, of course, different prices, but the thing is that there are practically 3 big Bitcoin exchanges. And like a couple of months ago, the Mt. Gox exchange went bankrupt, which, well, changed the market quite a lot. But this Bitcoin price index takes this into consideration. It's the average of the most liquid and most active exchanges. So it kind of takes care of that. It's available from September 2011 till the end, well, and I use it till the end of February 2014. For other information about Bitcoin, I use the database on blockchain, and there's practically everything. Of course, there is many more data points, data series. You can get to the actual transactions with timestamps. You know, much more information about what's going on. For the measures of attention or interest, I use Google Trends data and Wikipedia data from standard sites. As for financial stress index, I use the one of Cleveland Fed. This is the standard one. And for gold, well, there is this website called nicelygold.org, so I use the price there. And the prices and the traded volume of the Chinese Bitcoin market I use from Bitcoin charts. Now, what are the results? I hope you can see at least something. But I took all these potential drivers, and I checked whether there is something going on or not. Well, I will probably skip through some of them, and I will touch the most important ones, or the ones I think are the most important. So the first one is the relationship between Bitcoin price and trade exchange ratio. This is a ratio between transactions being made for actual real-world transaction. Okay, going and buying sandwich, paying with Bitcoins. Okay, and it's ratio between these real transactions and the transactions on the exchanges, which are of course real as well, but they are not actual purchases of goods for Bitcoin. this is kind of a measure how much the currency is used in the real world. And from theory, if the currency is used for real transactions, the price should go up. So we should see arrows pointing. Well, actually here the ratio is the other way around. Okay, so it's the exchange transaction divided by the real transactions. So the expected correlation is negative. So the arrows should be pointing to the left. And we can see that this is true mainly for high scales. Okay, so in the long term. In the long term, we can see that really the more the Bitcoin is used for real world transactions, the higher the price in the long term. So something we would expect from the theory. If we look at the price level, well, of course, we have some episodes that, well, we always have these episodes. I don't have time for that. If you want more details about it, try to, well, go and download a paper because it's discussed in more detail. More interesting ones probably. The first line shows the hash rate and the difficulty. So this is quite interesting because if you become a miner, it can be taken as kind of an alternative to investing into Bitcoin. So you are not really investing in the Bitcoin itself, you are investing into your computational power. And through these costs, these are the investments, you can earn Bitcoin. So it's kind of an alternative. And it's interesting to see whether there is some kind of interaction between these. And it turns out that, again, the relationship is there mainly in the long term, as for most of the series, showing that actually the increasing price, at least in the beginning or in the first 2 years, well, in the first half of the sample, the increasing price motivated the miners to mine, actually. But as more miners were entering and as more of these hardware components designed specifically for mining went into the market, it became really hard to actually make profit on mining. So this effect kind of weakened. Okay, I don't have much time, so I will go to Google and Wikipedia. This is something quite expected, I would say, because I published a paper on this Google and Wikipedia interest and Bitcoin in 2013. So this was kind of expected that there should be some kind of a relationship. But the results are quite different from what you saw on Wednesday. Because on Wednesday, Chester presented the results that practically there was something going on only during the crisis. In a way, that there was a relationship during a crisis. But what we see here, and this is what makes Bitcoin very different, is that we can see very strong relationship. Of course, again, in the long term, but still, the higher the interest in the currency, the higher the prices. So the more the people are interested in the currency, even in the long term, the higher the price. So the more people want to know about it, the more they are interested in it, the higher the price, which is quite interesting. And again, we have these episodes, and these are really specific because that's the episode when of one of the bubbles. Okay, this is one of the biggest bubbles here going on. So the increasing interest is boosting the prices more up. But after the bubble burst, which is exactly here, then very quickly people are more into Bitcoin, but they actually want to sell it. Okay, so there is some kind of asymmetry, but something that we see, or we saw on Wednesday, even for real markets, let's say, for stock markets. So this is quite interesting. Practically the same thing for Wikipedia. The information hidden there is practically the same. Now, these are for the safe haven. There is practically no relationship. Okay, we see some of these islands, but these are, from my interpretation, these are mainly connected to the value of gold rather than of Bitcoin itself. Practically no relationship to the financial stress index. For China, the story is a little bit different. The prices are highly correlated, as expected, of course. And the higher the volume, or, well, the volumes are also highly correlated, but only from 2013 onwards. And this is mainly due to the fact that before 2013, the market in China was really shallow. There was nothing going on. It started from 2013 onwards. That's why only from 2013 onwards there is something. But what might be interesting is whether the increasing volume in China causes something in the US. And it seems that it might be in the long term. Okay? that the increasing volume of Bitcoins in China increases the prices or increases the, well, the demand for Bitcoins in the US dollars. But as we see here, the volumes of the Chinese and US markets is really correlated. So this can be spurious. So fortunately, there is a way how to control for that, and this is called partial wavelet coherence. After controlling for that, there is nothing left here anymore. Okay, so the relationship between the Chinese market, at least on the daily frequency, is not really there. So to sum up, most importantly, because the motivation was to somehow settle whether the economists are right or whether the Bitcoin fans are right. And it seems that, in a way, both of them. It's somewhere in the middle. Okay? So both the speculation or the interest, which I think can be measured by Google and Wikipedia interest, of course, by autocorrelations, which are not shown there. This is different kind of analysis. But also, the fundamentals play a role, which is really important. Okay? Because and what's also important is the fact that it's without any assumptions. It's just by looking at the data, looking at the correlations, without assuming much, and showing that it's really there. So both the speculation, but also the fundamentals, which is quite interesting and important from my point of view. The fact that China doesn't seem to play a role, from my point of view, is attributed mainly to the fact that I'm looking at daily data. I'm not looking at high-frequency data. And this is given by, well, number of transactions, the money supply, and stuff like that, because I'm interested in macro level more. But if I actually looked at what's going on the Chinese market, like at the point of time when Baidu says, okay, we don't want Bitcoin anymore, what the effect is, that would be a different story. So I'm not saying China doesn't play a role. I think it does, but at higher frequencies, not on daily basis. So thank you very much, and if you're interested in some of the papers, these are connected to the presentation, mainly the first one, that's practically the paper that I presented, but the two additional ones in scientific reports are more connected to Google Trends and Wikipedia research. So thank you very much.